This is a video presentation of the paper Establishing the Representational Faithfulness of Financial Accounting Information Using Multi-Party Security, Network Analysis and a Blockchain. The video is narrated by JohnMcCallig. The paper is by JohnMcCallig from the UCD Michael Smurfit Graduate Business School in Dublin, Alastair Robb from the University of Queensland Business School, and Fiona Rohde from the University of Queensland Business School and TC Burns School of Law, both in Australia. The paper is published in the International Journal of Accounting Information Systems in June 2019. The DOI is on this page if you want to look it up. This paper uses an objective function that comes from the accounting literature, and that is representational faithfulness. So in a paper like this, where we're trying to talk about something new, it's important to have a strong objective function, and what we use here is something that has been developed by the accounting profession in their conceptual frameworks, and representationally faithful financial information represents the phenomena that it purports to represent. So this gives us a link between what we see in financial statements and economic reality. The paper, the aim of the paper is to produce a design, so it's a design paper for the financial reporting and audit of receivables. So it is limited in scope to the receivables area of financial accounting. Receivables are the obligations that other entities have to the entity that you're dealing with. We use the design science research framework to organize our work. There are 4 stages to design science research, at least in the framework that we use. The first is problem identification and motivation. The second is setting out objectives of a solution. The third is the design phase, and the fourth is evaluating the solution. The problem that we identify is an accounting problem. Stakeholders can find it difficult to establish whether financial reporting information does represent what it purports to, because of 2 problems: information asymmetry and agency problems. And these problems are well established in the accounting literature. Essentially what this means is that outsiders to the firm can find it hard to work out whether the information that's presented to them in financial statements is credible or not. Independent auditors are one mechanism that can increase the credibility of financial disclosures. What auditors do is that they are given access to the entity's private information that outsiders would not normally see, and then they report whether this private information faithfully represents the information in the financial statements. And as well as looking at the internal private information, they can also confirm that private information with outside parties. This paper will deal with that particular phenomenon. So our situation is, let's say we have a vendor, somebody who sells something, and they have a number of customers. The customers are going to owe the vendor money if the vendor sells on credit, which we will assume they do. And our job is to assess whether the sum of the customer's balances has any credibility, the one that's reported by the entity. So the vendor will internally have a list of customer balances, and what will be reported externally is the sum of that list. The traditional solution to this problem is to engage an auditor. And the auditor will get internal access to the list of customers' balances. They will then communicate with at least some of the customers, a sample of the customers, and ask them, is this the balance that you owe to the vendor? If they reply in the positive, then the auditor is able to gather audit evidence on this list of customer balances and also express some sort of an opinion as to whether this sum of customer balances actually represents economic reality. So that's our problem. The objectives of our solution is that the sum of customer balances that's reported to outsiders would faithfully represent economic reality. And this involves it being complete. This means that the depiction includes all information necessary for a user to understand the phenomena being depicted. Neutral, so eliminate bias from the depiction. And free from error, so get rid of errors in the information that's presented. We also need to worry about privacy, in that we want the solution that we come up with to be similar to this current situation where the company's information is kept private, at least the detailed information is kept private. The individual items on the list of customer balances is kept private to the firm and to the customers, whereas it's only the sum of the list is disclosed to outsiders. So we're now moving on to the design and development of the system. Our first insight here is that there's already information sharing in the system between the vendor and the customers. The vendor knows what the customer owes, the customer knows what the customer owes. And we try and use that to solve the problem. The technique we use is called secure multiparty computation, and this technique, which is well established in the computer science literature, involves problems where you have information scattered over a number of different parties and you need to work out some function of that information, and in our case it's simply the sum of that information. The good thing about secure multi-party computation is that the information can be kept private, even though we are able to confirm the sum of that information, and that is the real trick here, and that is why it is attractive to us to use this technique in our solution. So how would this work? We'd have our list of customer balances. We need to report the sum of customer balances. Well, using secure multi-party computation, the customers need to communicate with each other certain numbers according to a certain protocol. These are not the raw customer balances. These are random numbers that have been generated according to a certain function. When they communicate these numbers with each other, they are then able to produce another set of numbers that, when subjected to certain mathematical functions, will result in the sum of their balances. And that should be equal here to the sum of customer balances that has been disclosed. You can see the details of how this works in the paper. There's an illustrated example of how this works in the paper if you want more details. The second element of our design is in terms of managing identity. If we are going to have all this communication happening between customers and the firm, then we need some concept of identity. And in order to guard the privacy of the firms involved, we do not want to use real world identity in terms of company names or addresses. We want to use something else. And in this regard, we're inspired by the way a blockchain works, where they use a variation of public-private key cryptography. And public key cryptography involves each participant coming up with a public key and a private key that are mathematically related. They keep their private key private, and the public key can then be used as a way to send them messages. In the blockchain application, the public key is essentially used as an identifier for somebody on the blockchain, or at least an account on the blockchain. So this is how our solution would work. The customers would all have to communicate with each other under a certain protocol. This could all be done in an ERP system. ERPs could be programmed to communicate in this way. We would have to communicate with each customer the other customers that they needed to communicate with, and this could be done through a blockchain application. The customers then need to send some information to the blockchain that's stored on the blockchain, and public access would be allowed to the blockchain, allowing anybody, any stakeholder down here, to confirm the sum of customer balances. This could also be used by an auditor as an aid to their auditing techniques, and as a way of gathering audit evidence. So you wouldn't necessarily need the stakeholders to do this by themselves. There is one problem with this system, and that is that when we're using public keys as identifiers, it would be very easy to set up a fake public key and then confirm that company owed you money. And this would be one way of carrying out a fraud. So what we would need to do is to build a map of the network using the information that's been lodged onto the blockchain, and use this map to work out whether customers were real or not real. And the way we would do that is to look at their location within the financial map. So who's related to who owes money to who. And if we found some customers that seem to not have relationships with other companies, that are just floating there in space, then we might be suspicious of them. So what we could do here is what's called in network analysis a network cut. This is the vendor that we're interested in, and they have all sorts of relationships. This would obviously be a much more complex map. And if we take away that vendor, we can see that there is a little map here, or a sub map that is really quite cut off from the rest of the network, and we might be suspicious of that. So to conclude, this paper shows that recognizing that some of the firm's private data is already shared with others allows us to use multi-party security to establish the representational faithfulness of financial reporting information. Secondly, using public key cryptography and network analysis, we can use a different kind of identity for the firm than we're used to using. Identity is established using a location on a network rather than legal status. And then we can manage all this information transfer and give public access to the information without breaching the privacy of the parties using a blockchain. So these type of ideas allow us to at least start to consider the future of financial reporting systems. Financial reporting systems are really quite traditional, and go back a long way at the moment, and other areas of life have moved on, and business have moved on to use much more technological concepts of networks and identity and information sharing, and financial reporting could really benefit from thinking about how these methods could be used. So thank you for for listening to this presentation, and the paper is available at the DOI at the start of this presentation. Thank you.